Good morning. It is Thursday morning, and as always, every week it is something to talk about. There's so much going on right now, and I don't know about your world, but Megan and I were just sitting here talking about all of the good things that happened over the last couple of years. Yes, the craziness, the exhaustion, the madhouse in the business. It seemed to just store up all of the issues for the first 3 months, the first quarter 2023.
Yeah.
Is how can we overcome as many things as possible? So we're doing the thing. And that's honestly where my quote this morning came from, because every really deep conversation I'm having right now with good friends, and many of my good friends are real estate agents, as you can imagine, all of those deep conversations are getting to the point to which what just happened.
Mhm.
Right. And it's not just about the volume coming down, because we're all in that same boat together, but it's like what just happened to my life or the world or these family relationships or all of these other things that I could go on and list. And I know that things can seem really tough sometimes. And that's where, and I'm going through my own load of changes. And I know we just talked, you're going through changes again.
Going through changes again.
So here's my quote. What comes easy won't last. What lasts won't come easy. It is these hard times that makes us stronger. It is these moments where we have to dig deep to rely on those that we trust the most. When I can call you at early morning, 3:30 in the morning.
I emailed Nicole at 3:30 in the morning. I think I had texted you yesterday. I was up at 6, couldn't sleep. So I was like, well, we're just going to start working.
When you can call those friends, those companions, those coworkers, and really go deep right now in this time and band together, not only personally, but professionally. Professionally, this industry is going through a massive shift. We know inventory is going to continue to be the headline of the year. We know the volatility of the interest rates and what's happening. We're going to talk in just a minute about pending home sales and what's happening with closed loans and what kind of activity level we're seeing. We know that those buyers that want the perfect home have to rush in and have to give a lot of money to get it. And those homes and those sellers that are sitting on the market when they didn't take the time to price their home right or stage it, are stressed. Like, we know all the things are happening. How do we continue to be together, to band together, to be the best version of ourselves for not only ourselves, but our teammates and our coworkers and our friends in a time like this when change abound. So Megan, how are you doing?
Good.
Yes.
Doing great. Doing great. It has been a week.
Yes.
And so, I've really been watching different districts really closely. I threw it on social media earlier this week. What school district are you in, and when was your spring break? And so this is the last week of spring break. We've been going through it for the last 3 weeks or so in a row. And we've noted that showing activity has been down, pending transactions have been down slightly. Most notably last week. This week they picked up just a little bit or held flat, but hopefully next week we'll start to see that pop of activity again.
Yeah.
We've got Easter on the horizon.
We do.
And so going into Easter weekend, we end up seeing probably about a 15 to a 20% decrease in pending and showing activity going into that holiday weekend. People are spending time with families and they're not necessarily out looking at homes. So I would avoid listing over that weekend. But if you've had a buyer that has been really challenged in this market and they're not able to compete in multiple offers, or they're not able to go significantly over asking price looking over Easter weekend, it's probably going to be a good thing for you. So take advantage of that time frame.
So this weekend is a great weekend to list.
This weekend is a great weekend.
It's Thursday already, but if you've got your ducks in a row.
Yes. Definitely. And so I am expecting, and I'm really curious to see what's happening, as we've talked about this before in our previous webinars, that there's a compression cycle that exists. There's a compression and a retraction cycle that happens every year, where we end up seeing the market on fire from February through about April. And we end up having more units going under contract than homes to sell folks. That creates these multiple offer situations. And then we have a retraction phase that happens directly following Independence Day through the end of September, where we end up seeing prices fall back ever so slightly because we have more homes for sale than buyers that want to purchase those homes, less people moving. So we're in our compression cycle right now. And I don't know that our compression cycle is going to last as long as what we've seen previously. Historically, it goes from February through May, but May is kind of funky this year because we've got Cinco de Mayo on Friday. We've got Mother's Day the following weekend, then all of the graduations, and then Memorial Day at the end of the month.
So every weekend something.
Every weekend, something is going on in May. And so I would encourage you to get your listings to market sooner rather than later. Let's pop up the strategy sheet so I can share this with you, but I don't know that we're going to see our market going quite as crazy as what we've seen before as we get into May. Also looking at, do I have the right screen shared?
You do not.
I do not.
We're seeing the slide deck.
Let's do this.
Well, hang on. No. You're good.
Okay, well, we'll do it
just
this
changed.
way.
Okay.
So looking at our market strategy sheets, I think it's really important that you guys are sharing this with your clients right now about what's going to be happening in the Metro Denver market and getting those listings to market in April. As you can see, your target listing month across the top of the report here, and your target closing month based off of average days on market for that month historically and days from contract to closing, that April is really your best time frame in which to list, where we start to see the market heat up, and that's where it's most competitive. Now, for your buyers, again, if they've had a harder time getting stuff under contract, they're not competing, waiting until late July after Independence Day weekend, you can see that the market really starts to shift and pull back. And we tend to note that there's about a 3% decline in average sales price as we get into the later parts of July. And so keep that in mind as you guys are trying to set apart your strategy getting into these next couple of weeks. I know a lot of sellers want to try to wait until May or June to list their home because they want the kids to be out of school, but you really do have a better shot and a higher and better odds of selling of getting it under contract if they list earlier in the year. Hopefully you can negotiate in a lease back, something along those lines, so that you're not having to do the double move, because that can be really tedious to try and go through that process. But really now is the time frame where we end up seeing the best odds of selling for those transactions. Looking at our strategy sheets for 2023, you can see that we were red, but not quite as red as where we were at the very beginning of March. So the last week in February and the beginning of March were the hottest weeks so far this year to sell. We'll see if these odds start to increase as we get into April. But as we start to get into April, we note that more new listings make their way to market. A lot of families who intend to sell in the spring months take that week of spring break and they list, or they take that week to spoof up their home and get it ready for sale, and then list the following week after they're done with spring break. And so it's interesting to see some of these trends that are rolling through right now. But again, we ended up seeing just a slight cooling pattern this last week, and it held pretty consistent with the previous week. This week, we ended up having Denver Public Schools on spring break. A lot of the private schools were on spring break this week again. And so again, that takes some time out of the marketplace where people aren't necessarily looking at homes. Interestingly enough, our average daily active count came in at 0.8% down for the week. We had about 3,700 available total homes for sale, and we ended up putting up the exact same amount of new listings this week as we did last week.
Interesting.
993 new listings entered the market, but we put 1,014 units under contracts. We're still in our compression cycle here where we're putting more units under contract than we're putting up new listings for sale. So our month supply of inventory is holding pretty fast at 0.8 months worth of inventory, indicating that multiple offers are likely. Now, again, keep in mind that our market is really segmented as to where we're seeing multiple offers. If you're looking in Lodo or just south of the airport, down into Sterling Ranch, on the outer ring suburbs, you're less likely to see those multiple offers. And also in some of those more urban, densely populated neighborhoods like Lodo, getting into some of the more central Denver neighborhoods, we're less likely to see those as home prices get higher. But in the inner landlocked ring suburbs like Lakewood and Wheat Ridge and Littleton, getting down into some of the portions that run along the 225 corridor, up along I-25 to the east side between 120th and 144th in Northglenn and Thornton, those areas are really hot. Arvada and Westminster are also below 1 month worth of inventory. So that's where you're most likely to see these multiple offers coming out of the marketplace right now. Interestingly enough, the multi-million-dollar segment is faring very well right now. There was a break for spring break where a lot of those folks did choose to go on spring break rather than to look at homes. But when a good home comes up for sale in the multi-million-dollar market, we are seeing multiple offers coming out for those, especially those that are updated and turnkey and show ready. They are going under contract very quickly, and oftentimes for for multiple offers, which is interesting. They have less bearing on what happens with interest rates because a lot of them are cash transactions. And I want to know, where are all of these cash transactions coming from? And am I in the wrong line of business? Because these are some pretty big cash transactions that I'm watching going on right now. I had someone reach out to me and talk to me about the under $500,000 segment right now. And they wanted to know how many cash transactions were under 500,000. And in the last 30 days, it's been about 19% of those were cash transactions. Whereas if you go over $1 million, it's nearly 40% of those transactions are cash transactions.
I've been talking to a lot of buyers who are selling, taking that equity that they've gained. And we're going to show a couple of data points from NAR, just producer buyer and sellers guys. That's up on the NAR's website. And they were talking about the baby boomers they're the lead on the sellers and the buyers right now. They actually came up and over my generation, right? So as they're coming more into the play, they're doing it with cash. They're selling that $1.1 million house and they're buying the $600,000 condo with cash. And I'm talking to them about doing a bridge loan or maybe introducing a reverse mortgage. But we are definitely seeing some of those folks coming in and taking care of cash. I have a question about the months of inventory and just what you saw like in that 2012 to 2019 timeframe. Now, months of inventory is a balance between the supply and demand, and we've got more demand on our horizon with our first-time home buyers. We know that. With the limited, the progressively limited inventory that we're seeing right now, do you see that this is lower than historical average, or do you see it getting worse than historic average?
So what we're looking at for the month of March for those listings for month supply of inventory based on our strategy sheets, historically we have about 1.6 months worth of inventory. So we're actually shorter than where we would normally be for the month of March right now. And so 0.8 months worth of inventory is still historically low. And I've got a lot of questions about, when do you expect to see more inventory come in line? In the short run, I expect April to see gains in our active inventory, and inventory tends to grow from April until September. September is typically our top month for the most number of listings that we have available in our market. But to get over even 6,000 active listings, 5,000 active listings, I think it's going to take some time because we have interest rate gridlock right now, where a lot of people refinanced into the 2s and 3s. And now they don't want to move into a smaller house for more money. And so it's interesting to see this type of dynamic where people are spending more times in their homes because they've got a really great interest rate and they don't want to list and they don't really have anywhere to go because inventory is so limited right now.
Yeah, we've been talking about how many home buyers or homeowners who have a mortgage have an interest rate locked in under 5. Almost everyone. It's like 99% of all homeowners have an interest rate under 6. So we're still above where those interest rates are. So it costs more to get into a smaller home.
It does. It costs more to get into a smaller home. Looking at our odds of selling, it declined this week by about 0.4%. We peaked out about 3 or 4 weeks ago at about a 66.7% odds of selling. We're still sitting at about a 64% odds of selling, which still beats what we would typically expect for the month of March. Normally in the month of March, we end up seeing about a 59 to a 60% odds of selling. So it's been faring very well. Even in light of having higher interest rates, there's still demand out there. And the relationship between supply and demand still dictates that multiple offers are likely. We're still far from a market imbalance. We were just talking about this. For us to get back to that magical 6-month supply of inventory where we would have a balanced market, we would need to have about 26,500 total listings available for sale, whereas we only have about 13.9% of balance right now. Based off of data from last week, showings did go up from 1 week to the next. We saw an increase by about 3.3% with about 14,500 total showings that were set this last week, which means that you should have been getting about 4 shows per property per week. If you're not getting 4 shows per property per week, please be sure to go through and look at if you're getting your shows to pending. If you've had a total of 14 showings and no offers, those could be your 2 signals that it may be time to go through and make a price reduction. Median days on market has been holding in at about 8 median days on market, way down from where we were back in November and December, but still twice as long as where we were a year ago, where it was about 4 median days on market. So 8, not too shabby. That's a pretty quick market still. Price reductions continue to decrease. They decreased by about 0.5% from last week to this week. We were looking at about a 25.2% rate of decreases for properties that went under contract last week, with 71, 72% remaining unchanged in the marketplace. We saw about the average price reduction ended up going up by about 0.1%. We saw about a 4.9% price reduction off of the original price last week. We're about $35,500 off of that original price. Now, this does cover all price ranges, and so it's going to be more attuned to what's happening with our average price point range right now. So it's
Makes
going to be
sense.
in line with that stuff that's around that $700,000 mark right now. So let's talk about the under $500,000 market. This is only 27.1% of our overall inventory. Our strategy sheets do show that you do have a little bit more of an extended selling season. If you're under $500,000, the demand lasts a little bit longer. So May still looks really good for a lot of that, but April really is still your best time frame in which to list in. Looking at our strategy sheets broken out by week for just this last week for 2023 still remains consistently hot. We did see some cooling trends that ended up happening with a couple of our metrics for closed transactions, showing activity, new listings making their way to market where we saw fewer of those. This last week, we ended up seeing that our average daily active count came down by 2.6% and new listings were down by 7.3% this last week in favor of not listing over spring break week. Overall pending transactions went up by 5.6% week over week with 397 units going under contract. And our month supply of inventory is sitting at 0.5 months worth of inventory and has been at 0.5 months worth of inventory for about 6 weeks now. And so that number is not really moving. We'll see what April has to bring, but it's likely to continue to stay at the same frenzied pace for these homes that are under $500,000. Odds of selling remain pretty much consistent from where we were last week. You've got a 74.5% odds of selling. Again, the odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same week and project it forward for a 30-day period of time. So that's the likelihood of you going under contract and closing if you listed last week at 74.5%. That number continues to climb. Historically, in the month of April, we have the highest and the best odds of selling. So again, looking forward toward those April transactions. This market, we're even more far out of whack. We would need to have about 10,500 total available listings for sale in order to offset demand, whereas we only have about 8% of a balanced market in the under $500,000 segment. We're getting more shows per property per week in this price range. We're looking at about 6.8 shows per property per week with about 5,700 total showings that were set this last week. So if you didn't get 7 showings on your listing last week, it may be time to consider a price reduction if you're under $500,000. Conversely, we're looking at about 14 showings before going under contract. So if you've had a total of 14 showings and no offers, that may be your signal to make a price reduction and 7 median days on market. That actually went up one day. That's probably spring break effect that's happening there where people were out of town, coming back, taking a look and looking at about 7 median days on
Did you
market.
leave town for spring break?
No, I'm going out of town in April.
In
So,
April.
in
That's right, you're going to
April.
Hawaii.
No, it was dad's week for spring break this week. So dad got the kids. So I worked like an 80-hour work week
Right.
because I don't have the kids.
I
So
did not do spring break either.
yeah, no spring break this year. Price reductions were lower at the under $500,000 segment with about 24.5% of homes that went under contract last week made a price reduction with 73% remaining unchanged. Average price reduction was up this last week by a full percent. We saw about a 5.5% price reduction or about $24,000 off of that original listing price. 500 to $1 million. I've had a lot of requests for people to say, Megan, can you go through and segment this out into 500 to 750
I get
and
that.
750 to $1 million?
I get that.
I can't go back historically and recreate
No.
some of this data by week.
Right.
I could if it were by month, but by week, I can't go back and historically break it out. And so you're going to see that these numbers are going to change and shift. If you're between 500 to 750 and 750 to $1 million, there's going to be a difference. And it kind of cuts off at that
Yeah.
conforming loan rate when you transition into a jumbo market versus a conforming loan limit.
Right.
And so there
Right.
is a difference in there. And unfortunately, I can't go back and change this. But if you look at the monthly reports, in the monthly reports, I've got it from 500 to 699, 700 to 890, or I'm sorry, I've got it from 500, 400 to 600, 600 to 800
Okay.
and 800 to $1 million. So
That's
in the
huge.
monthly reports, I've got it broken down into $200,000 price segments. So you can see how those markets shift, but I can't go back historically and recreate this data. Looking at our strategy sheets, again, you start to see that cooling pattern early May. We start to see some of that transition where we start to see more of that new listing inventory really make its way to market, but April is your best time frame to be in the marketplace. Cooling trends start to settle in as we get into June, July, August, and September. This last week for pending pending transactions and our market activity, we ended up seeing that there were more new listings that made their way to market. Days on market or days towards balance ended up going down. And we ended up seeing that total showings, shows per property ended up going down this last week as well. So slightly cooler market overall versus where we were in the last week. This month or this week, we ended up seeing our predictive month supply of inventory sitting at 0.9. I would say that if you're over the 750 mark, you're probably sitting at about 1.2 months worth of inventory versus under the 750 mark, you're at 0.9 months worth of inventory. New listing inventory ended up going up this last week by about 6.5%, but our average daily active count was down overall by about 1%, and pending transaction count was down by about 2.7%. Back on markets ended up going up this last week by about 3.1%, with 100 units returning to market after being either in an off-market status, being under contract, expired, or withdrawn, being listed at this point. But our active inventory started to creep up as we got into March, but not huge gains. We expect to see bigger gains as we get into April. The odds of selling fell by about 0.5% this last week to 63.3%. Again, I'm satisfied with that number. The highest I've ever measured that number for this market pre-COVID was 61%. And so 63.3% odds of selling in our most interest rate dependent category, our most loan dependent category, I'm satisfied with. So I will take that number all day long. This market only has 14.6% of balance. So again, we're not looking at a huge bunch of transition in this market. We saw about 3.4 shows per property per week. So make sure you're getting your 3.5 showings per property per week. We're looking at about 13 showings to go under contract. So that number has started to come down. So people are looking at fewer homes before going under contract. We're looking at about 8 median days on market right now. So again, still a quick moving market that was down by 1 day from the previous week. In this market, we only saw 24.8% of them reduce their price, with 71.5% making no changes to their price whatsoever. Price reductions came down this week. We saw a 4.4% price reduction, or about $34,500 off of that original asking price. 1.5 to 2 million, our market really starts to get small as we get into this over $1 million segment. This is only about 7.6% of our overall inventory. And again, your best time frame to list is March, April. We start to see more inventory make its way to market, and we start to see our expired count going up, and our percent of average close price, or our average close price ends up actually falling during the month of April, which is kind of an interesting trend to see. But overall, historically, again, March is your best time frame to list. Looking at this market for last week, you can see that these sells aren't quite as red as what we were looking at before we went into spring break week, where we had our hottest week of the month of the year so far in that first second week of March. And then people went on spring break, as they tend to do in the over $1 million segment. We start to see a cooling trend set in. Overall, in this market, our average daily active count did go up by 0.9%. New listings, however, were down by about 20.5%. Pending transactions were down again this week by another 9% due to spring break. And so we're looking at about a 1.3 month supply of inventory in this overall market. That's been slowly climbing for the last 2 or 3 weeks. Again, that first weekend in March, we were at 1 month of inventory. Now we're at 1.3 months worth of inventory, which is still historically not that bad, but we have been watching our active inventory climb since the beginning of the year. It took a little dip at the beginning of March, but is back on an upward trajectory again. Odds of selling, we peaked at about 3 weeks ago, where we ended up hitting about a 56% odds of selling. Now we're sitting at about a 54.1% odds of selling. We only have 14.4% of market imbalance in this area. So again, we're not seeing a big shift or a big influx of new inventory making its way to market. We had about 2.4 shows per property per week. So if you're not getting 2.4 shows per property per week, it may be time to make a price reduction, and about 14 showings to go under contract. 14 median days on market. So up from where we were the last week at 6 median days on market. Now we're sitting about 14 median days on market right now. 69.5% of these homes made no change to their price, whereas 28.8% made a price reduction last week. We were looking at a smaller price reduction at 5.2%, or about $70,000 off of the original price for these over $1 million segment. 1.5 to 2 million only represents about 2.8% of our overall market. This market really is the best in March. You can see how much my color patterns dissociate when I'm dealing with smaller amounts of data between 1.5 to 2 million, but it does show that March is your best time frame to list. Getting into April, not too shabby as well. Based off of data from this last week, cooling trend really settled in. It picked up a little bit more from where we were in the last week, but not by much as we started to see more inventory making its way to market.
It feels like the over million is so much more of the market than what it actually is.
Yes.
Right? Because everybody's talking about the over million. Everybody's home is 1.1, 1.2, 1.3. And
Yeah.
and that, even to have first time home buyers trying to get qualified for $1 million home.
Yeah.
So it is shocking that it's such a small percentage.
It is. It is a
Yes.
small percentage overall of our market. In this market for 1.5 to 2 million, our average daily active count came up by 0.6%. We had 175 total units available for sale. Pending transactions went up by about 5.3% with 20 units going under contract, making our month supply of inventory at about 2 months. So that means for every one buyer in the market, they have about 2 homes to choose from. The odds of selling had a nice boost this week. We came up to about 49.9% odds of selling, which is down from where we were at the end of February, where we hit a 57.6% odds of selling. In this market, we still only have 16.8% of the inventory required to offset demand, and we're looking at about 2.2 shows per property per week. We ended up having a lot of looky-loos with 392 total showings that were set, but only 20 units went under contract. So it was about 19.6 shows to go under contract. These buyers are being really picky in this market about what they're putting under contract for 1.5 to $2 million right now. We've got about 14.5 to 15 median days on market for this 1.5 to $2 million range. And about 40% of them made price reductions last week. So we saw a big jump week over week in the amount of homes that ended up making price decreases. 60% remained unchanged. The average price reduction was smaller though. It was about a 5.8% price reduction, or about $109,000 off of their original asking price. Now, I've had a lot of questions lately for the $2 to $3 million price points, and I can't break it down weekly because I'm literally looking at 4 to 10 listings at a time when I look at this $2 to $3 million segment.
Right.
So there's no trend to reveal there. I'm simply looking at comps at that point. But 1.6 point of our this is 1.6 of our overall market. And again, looking at our strategy sheets, March is really your best time frame to list in. Early April, late April through May, the market really starts to cool down. So March is your best time frame in which to be listed for these particular markets. Whoa, what did I do to our screens? Oh no. Oh no, this is totally going to mess up when you go to do your presentation. Hold on
Here,
just a sec.
let's see if we can get to
Let's do this.
yeah. Oh, there we go.
Okay, fixed it. So it looks like we've got some questions. We'll pop in and answer these really quick. How do the new build properties fall into these statistics? Well, they don't. Unless a builder is listing new construction in the MLS and listing all of their inventory for sale, I don't track that. A better search for new construction stats would be through Zonda. It's Zonda.
Yes.
Tracks new construction. So I would reach out to them and see if they have any data that they can share with you. Not a question, but perspective. My cash buyers are many times taking from their investment portfolios to buy and will turn around and cash out refinance. I do see that happening. I don't have a way to track that per se as to what percentage of them are going through and refinancing after the fact, but some of them may be pulling from their investments in order to make these purchases. And so these large investment portfolios in order to make these types of purchases.
And an interesting statistic. So refinances are actually going up, which you wouldn't think that because the interest rates are still higher, but it would collaborate on this kind of point to where if people are buying and we just had our house for sale and somebody did the same thing. They got a gift from mom and dad and they turned around and did a cash out refinance immediately after. So if people are doing that, we are seeing an increase or tick up in refinances. But you've got to remember that if you can negotiate getting a loan on a purchase, your purchase interest rate is going to be significantly better than the cash out refinance. Now, people are probably banking on the fact that interest rates are going to go down and I can just refinance again. But in the short term, you're better off if you can negotiate the opportunity to do a loan versus pulling money out of investments.
What percent of homes coming back under contract for the under $500,000 segment? It's about 8% right now for units going under contract under $500,000 that are now hitting the market again. Do you believe that most price reductions are based on overpriced listing? Homes that are priced right, good condition, usually go under contract right away. Even with less inventories, buyers will wait for the new listings that are priced right. I do believe that's true. I have had people ask me, should I list high knowing that I'm probably going to be making a price reduction? And I don't think that that's the case. It's also really tricky to go through and price properties right now.
Yeah.
Where I was talking to Larry Kendall, or I overheard some conversation that Larry Kendall was having, where you should be pricing in line with your comps right now and what the other active inventory is, rather than trying to go off of the historical data and make time adjustments, because it's really tricky to go through and make those time adjustments. How is the low high condo market and days on market? Is it better than Lodo? Only slightly. And so the downtown Denver market was sitting at about 4.6 to 5 months worth of inventory, whereas low high was sitting at about 3 months worth of inventory.
And there was a story that just came out on Bigger Pockets talking about the multi-units, and they're not talking about the 2 to 4 units. They're talking about the big apartment buildings. The massive number of apartment buildings or condo buildings that are being built are going to continue to put pressure on places like Lodo and Low-High, or any of the areas where you're specifically looking at more condos or shared walls and that kind of living environment.
Yeah. And so is Northeast Denver still slower than more central markets? So Northeast Denver, if you get out south of the airport, it's slow. You've got about 5 months worth of inventory out there, versus out into Green Valley Ranch, you're looking at about 2.5 months worth of inventory. As you get into Central Park in that area, you're below 1 month worth of inventory. So it really depends on where you're talking about in Northeast Denver. I'll have a better gauge on that next week when I go through and pull out the monthly numbers for you guys, and I'll probably go over the monthly numbers and not the weekly numbers with you guys next week, so that we can really check in and see where those hot spots are. But I'll have more on that for you next week. It appears current homes for sale are sellers that must sell, death, divorce, etc., give loan lock owners, etc. Not sure we will see an increase in listing. Yes, the people that are moving right now are the people that have to move.
Then they need to move. It's not the want to move buyers. Yeah.
I was dealing with 4 different death
you
transactions yesterday.
Yes.
I had
all
the probate issues was what I was dealing with yesterday, and whether or not something needs to go through probate. And so word to the wise, don't do your own deeds. Okay.
Oh my God. I warn that all the time.
Don't do your own deeds. It messes everything up, and it can really change the way that you sell your house.
Yes.
So don't write your own deeds. Nicole, at some point during your presentation, could you talk about your experience of how important is offering a concession for buy down closing costs for a condo townhome under 530,000?
Okay.
Yep, we'll talk about that. What about neighborhoods like Skyland? I would have to, Jill, text message me what that zip code is, and I can pull that up and take a look at that for you. My number is 720-229-6641. But in those markets, we're looking at about 1.5 months worth of inventory, if memory serves me correctly.
All right, so let's go ahead and get started on the back half of this. And as more questions come up, we can take a look at those. Oh, Daryl is curious about Skyland too. So Daryl, Megan just gave her phone number, and you'll be emailing out your contact information for everybody.
So you can reach out to me for your specific neighborhoods.
What's the average price reduction you're seeing for condos under 500?
So I don't have it separated into condos and detached on a weekly basis. But if memory serves me correct, it was about a 4.8% price reduction is what I was seeing on average.
All right, so let's jump in. I'm going to share my screen, and then we'll bounce back to any of the other questions that you guys have. Of course, it was not as big a news week as we had the last couple of weeks. We got to talk all about bank failures. That was fun. So, and the volatility that created in the markets. This week, we actually saw a return back towards where the 10-year Treasury yield was before the bank failures. So we saw this massive flight to safety. We saw the 10-year Treasury yield drop. There went the 30-year fixed mortgage rate. And then now we're actually seeing it creep back up again. A little bit of that. Well, we're not seeing an additional bank failure. So we had a lot, but every single one of them were saved by something. The FDIC either came in, I know the Fed came in with a quick program that they designed over the weekend where they were buying or backing bonds and loaning money based on par. And then you saw other banks swoop in and purchase suffering banks. So this really, we saw those banks which were failing recover quickly, not by themselves, but with help. And we saw the market stabilize. And as the market stabilized, we saw the interest rates were kind of returning to where they were. Now, as we continue to watch this, we'll talk about what's happening. Tomorrow is PCE. And so we're going to see inflation numbers again. Now, I would expect that it's not going to move the markets that much unless it says something totally different than the CPI did. But next week, then we have the jobs numbers and unemployment again. And so we have more news coming that's what the market is waiting for. Where really is inflation? Where really is the economic numbers? And how much are the bank failures impacting the ability to spend, right? Because some of those bank failures in the contraction is impacting lenders or banks' ability to lend, which isn't affecting home buying as much as it is business loans and car loans and commercial products. I mean, we are starting to see some noise in the commercial space that if you happen to have a loan coming due right about now, you might find some restrictions, right? So we're not seeing that as much in the residential space. But let's go ahead and share the screen and get going on this. All right. I always like to get rid of that. Okay, here we go. So yes, you know what doesn't come easy? This market right now. This market right now. We have to be on our game. We have to be constantly sharpening our saw. And it's not about going neck deep in the economic data. You don't have to do what Megan and I love doing. We love doing this. It's not about just absolutely engulfing yourself in all the market trend data. It's about taking the market trend data that speaks to you, that resonates for your specific micro market. And then how do you communicate that to your avatar, your community, your sphere, so that it communicates safety and stability when they need it most, right? So it's how are you using this data? Because right now there's a lot of blasting out, mostly negative data. And even if it's a neutral report, we tend to see that the news wants to put it into a negative light just to gain clicks, right? So that's what they're seeing. Most people don't read. We have to remember that. Most people just read the headlines. And so they go off of that. So you're just becoming more of that expert. You're advising them on where the market is headed. And then you're supporting them with their life decisions to move or to buy. And we're seeing that some of those people aren't buying right now because they don't want to buy less for more. So jumping in. Pending home sales came out this week and it rose for the third month in a row, which is really interesting because you can watch that pending home sales and interest rates usually are going to have an inverse relationship. So we saw this as interest rates climbed earlier through the year, right? And this is going to be February in here, but interest rates climbed up and we saw pending home sales declining. Well, we saw this little pop of interest rates. We all felt it over the last couple of weeks, and yet pending home sales continued to go up. It simply speaks to the resilience of the buyer. Like the buyer's kind of over it. Like, okay, my interest rate's in the 6s now. So I can live with that. Do I like it? I don't love it, but I understand it. I know what my budget is. I can work with it. And so we're seeing that the pending home sales, now this is a national number. Of course, Megan gives you all of those numbers per the zip code and per our price points, which is what you need to know when you're talking to your micro market, but understanding also what your buyers are hearing when they tune in to CNN, CNBC, Fox News, or whatever it is that they watch. When they hear these reports, how does that relate then to the local data? Being able to put those two into perspective. But overall, the pending sales is trying to gobble up what little inventory they're given. New home sales, which was actually last week, I had this in last week's presentation, was also up 1.1%. So new home sales were going under contract. Existing home sales pendings are going under contract outside of the market fluctuations locally based on the school districts that are on spring break. But overall, these markets are going up during a period of time where interest rates were going up. So this data is all going to be for February, which seems like a year ago at this point, doesn't it? Wow, this has been just the weirdest year so far. So all of these things, just talking to the resilience of buyers, mortgage purchase applications have actually been going up for the last for weeks. And we know we've seen a lot of volatility in interest rates. We saw a benefit in interest rates when the banks were collapsing, when we had multiple banks meeting the headlines. But even when the interest rates started to bounce back up again, when the CPI came out, or when we started to see more of that return towards risk, where people were pulling their money out of bonds and back towards stocks, when we're seeing that, we're still seeing mortgage purchase applications were up. So those increased 2%. And then we just talked about the fact that the refinances were up 5%. Which isn't all because of interest rates.
Mhm.
That is for sure. Now I've got several refinances going right now due to divorce,
Mhm.
right? So you've got people that need to do it just based on life. And you've
Mhm.
got these folks that are paying for cash with some other means, whether that's a gift or investing, or you've got just people taking advantage of maybe getting off of some of the higher interest rates and at least locking in something, because ultimately no one knows how low interest rates will go. You don't want to refinance all the way down and do it like 5 times. Some lenders will try and do that to you, but you do want to take advantage when there are significant dips. And we've had a couple of those along the way, but buyers continue to be resilient. They had been priced out, then they were feared out. And you have this massive swell of birth rates 33 years ago. That doesn't go away just because we have interest rate volatility,
Mhm.
right? They get used to their surroundings at some point in life, just simply moves on. I'm about to graduate. My mom's going to help me buy a home. I just turned 21,
Mhm.
my 3 kids, right? Or whatever that is with the lifestyle, the buyers are resilient. And owners are too. Delinquency rates are low. In fact, I saw that on your chart. It's at the very bottom,
Mhm.
and your delinquencies are like at 0.
Yes.
Across the board.
Yeah.
All price points. So we're just simply not seeing it. Homeowners right now are in a fantastic position, which will continue to put pressure on inventory. We are not going to see a release of short sales and foreclosures. A few, sure. For
So
those,
yeah, I've got
How
one
many?
that I'm dealing with right now.
Yes.
One that I'm dealing with right now. And it's basically because they bought at the peak of the market last year and then they lost their job. And so it's a really
Mhm.
unfortunate situation that we're going
Yes.
through. And I've got one foreclosure that we're trying to beat to auction. But other than that, I don't have any of that in my pipeline. A whole lot of dead people, but no, not a lot of distress transactions.
Oh, that's going to be our quote right there.
I
It's
know.
a whole lot of dead people.
A
God, it's awful.
whole lot of
Okay.
whole lot of death and divorce and probate right now.
We just went off the rails. We're coming back. But yeah, no, we're seeing that too. I just had an interesting call with, somebody that had it in a trust. She has since passed away. Then it was a trust and the and the new husband. And it's a lot of the title stuff. I mean,
Yeah.
it was all title stuff that they're coming up to me with.
Yes.
Yes.
A lot of title stuff right
Yeah.
now.
And I
A lot
would
of title
definitely say
stuff.
I want to double click on that especially because I work with so many investors.
Mhm.
So when you go to change title, especially if you're going to quit claim it into an LLC or a trust, do not do it yourselves. The title company will do it if you're sitting at the closing table right after a purchase.
Mhm.
But the moment you leave the table, I found that the liability risk is too high.
Right. And so
Yeah.
you can do it if you take it back to the title company that did the closing. You can
Yeah.
add an endorsement to title that costs about $100 to cover the
Okay.
owner policy
That's really good
for
to
the
know.
LLC. And so you want to do it right after the closing at the closing table to quit
Yeah.
claim it into the LLC.
Yes.
But you want to make sure, ideally, you want to add the endorsement to title so that you still have an owner policy, because you can unintentionally void your owner policy by quit claiming your property.
Good to know.
Yeah.
Okay, good to know.
Don't want to do that.
And definitely get a real estate attorney involved if that's the case, if you're coming and doing this after the fact, or you're working with trusts and you're trying to move all your properties into trusts. It is so worth spending a little bit of money to make sure that you do it right.
Yes.
Right. All right. So, and affordability is getting a little better. I don't want to go too far out on this limb because I might fall off, but affordability is getting a little bit better. We're seeing outside of the homes that are priced right and staged right and going for $100,000 over asking.
Mhm.
That's not helping affordability. But outside of that, we are seeing a flattening of home price increases overall, the median home prices and the average home prices. And we'll continue to watch the actual appreciation, which is slowing down, but still positive. But right now we're seeing that month over month. So the year over year increase was 3.8%. Now this is Case-Shiller. It's a data aggregator. It's a national number, but the month over month was down 0.25. So we'll just continue to watch this. It is slowing down. It is flattening out. It is helping affordability because many of the people that have jobs are getting raises. And so the income is not as much of an issue. And if your income continues to go up and those home prices are flattening out, even for a period of time, any dip in interest rates that you can get, that increase in affordability is there. But bigger picture, it doesn't feel like it. I get that. And that's why I don't want to go too far out on that limb. We're still coming back from a very high pickup in home prices over the last couple of years. But we are seeing nationwide that we're down 3% from the peak. I feel like we're down a little bit more than that here locally. Yeah. All right. But the bond market right now, we're in this wait and see. So we've entered into this kind of sideways pattern right here. We saw that we gained a lot of benefit with lower interest rates. This is a 10-year treasury yield. This is not the 30-year fixed rate, but the 30-year fixed rate and the 10-year treasury yield, remember, they are siblings. They are brother and sister, and they move together. Now, they might move further apart together, and they might move closer together. Right now, they're traveling further apart, and that's more due to risk. When they get closer is where you want them nationally or historically, sorry, they run at about a 1.6% spread. Right now, it's wider than that. And so you're not seeing all the gains every time the 10-year moves when you don't see all the gains in the 30-year fixed. But right now, we're kind of moving into the sideways pattern. You can kind of see it. We saw that because of the bank failures, we saw the yields come down, interest rates come down. We saw CPI, then we saw more bank failures, and we're just kind of in this sideways pattern waiting. We need to see some economic changes. We need to figure out if there's going to be any more bank failures, and we need to figure out if those bank failures are actually going to give us any benefit in inflation, right? Because that's obviously what Powell was saying at the last meeting. We're going to raise the Fed rate just a quarter, and then we might be able to hold based on the bank failures doing some of our work for us. So that's what we're waiting to hear. Of course, as we hear tomorrow's news with the PCE, if it changes anything, we'll send out our Friday text as well anyway, because we send it out every Friday. But of course, we'll talk about what the PCE is doing. Jobless claims just came up by 7,000. So we're seeing a few more people enter into the initial jobless claims period. That's that you can be in initial jobless claims. You can go on unemployment for the first time multiple times in your life, but you haven't been on unemployment, and now you just went back onto unemployment or went onto unemployment for the first time. You were part of the initial jobless claims. That actually went up. We've been looking for this. We've been looking for some sort of trends. It's certainly not a trend yet because it hasn't been doing it, but we'll continue to watch this, and then we'll get the job numbers next Friday. GDP is kind of sliding along. People keep spending. That's a really big deal. We've been seeing that. The retail sales numbers in January were wickedly strong. Then in February, they started to fall backwards again. But GDP is kind of falling back into what it was pre-pandemic. So we're just kind of seeing, where is the economy actually going? Is it going to break into a recession? Will people stop spending? Will this come down? Because remember, spending is a large portion of the GDP. So waiting to see that come down. So in the meantime, we have this inventory crux, right? In the meantime, it's this, what was it? The buy the house, date the rate.
Yeah, that was the saying.
That was the saying. So here's the next one. Love your mortgage, hate the house. Do you not want to sell because you've got a great interest rate? Now are you suffering through it? Like, I really don't love this neighborhood anymore. This house is really too small. Maybe it's too big. Maybe I need a more age appropriate home. But my God, how do you get rid of a 2.5 interest rate? Right? It's called life. It's called not being tied to something that's not gaining you any value. Having the conversation around, let's really dive into the numbers, because based on what you've gained in equity, can we either buy down the rate, right? That's the conversation. That's what Stephanie was talking about. Can you either get seller concessions to buy down the rate, or if you're selling, can I take some of that equity that you didn't work for? Let's just be honest. I didn't earn it. I didn't slave over it and sweat over it and put it in my savings account. I was gifted this equity. I bought a house for maybe $700,000. Now I want to turn around and sell it for $1.2 million. Some of that I could use to buy down the interest rate to a rate that makes it feel good again, right? Or I could get the seller to do it, especially if you're shopping for homes on a Tuesday. Like, that's the day to do it. Like, let all those hot homes go that are going for $25,000 to $100,000 over asking. get the first time home buyer in and able to negotiate and use some of those seller concessions to do either a permanent buy down or a temporary buy down. Now, we believe that interest rates are going to go down, but I like the idea of a permanent buy down even better than temporary, but we do them both, where you put yourself in a position where you're not giving up a fantastic interest rate to move into something else. So a little strategy goes a very long way in conversations in a mixed market like this. And it's going to continue to put pressure on our inventory. We know that. We're seeing that builders can't build fast enough. And especially with the banks happening, with the constriction on lending, you know who that's affecting?
The builders.
The builders.
The builders.
The builders. So we're going to continue to see pressure on builders who are looking to banks to fund their growth. I do know that we have a builder division that we are specifically doing vertical financing with our move-in companies. And a lot of people have been asking, Nicole, what are you doing? We're going to talk about that in just a minute. But with that move, we also now have vertical financing in a full builder division. So we had some great products before, but this just gives us the opportunity to do more of that and give us access to help some of that where the banks might be pulling back. That's where the mortgage lenders are having to step in. So definitely, I can't afford to move. So NAR just came out with their buyer and seller guide. So if you guys, you can go download that from the NAR website. They're talking about baby boomers just overtook millennials. So millennials were a big part of our growth, right? We've been talking about that. But right now, there's this push-pull where they're struggling. There's not enough inventory. Yes, they were priced out, then feared out, then can I get in? They were going to be the massive movement in buyers. And I think that they're still there. But right now, baby boomers have the equity. That's why they're winning, right? They have the homes that they bought for, I don't even know. I couldn't even imagine. Could you imagine like if you bought a home for like $60,000 and then now it's worth like $700,000?
That's my parents.
Yeah.
It's my parents.
So that's the baby boomers, right? So now they're 52% of the sellers, they're 39% of the home buyers, tapping into this market, making sure that you're staying relevant. How are you communicating? What form of media are you communicating with? What is the messaging? Having these conversations. I just had that conversation yesterday talking about selling a $1.1 million home and buying a $600,000 condo. What would that look like? Could we do the bridge loan? I had 4 options by the time we got off the phone with them, whether it was a reverse mortgage purchase, keeping most of his money in his investments, a reverse mortgage cash out on another property that he had just bought in Arizona, or whether it was a bridge loan or hard money loan, or we have options that go beyond just a simple yes or no, right? So it's the strategy that makes the difference in this kind of market, especially with baby boomers, because a lot of them, they bought a home in a market that was relatively easy to buy a home in comparatively, without the information coming at them at 90 miles an hour like it is right now, trying to disseminate and quiet down the noise. Because they literally said that to me yesterday afternoon, this amazing couple that I got to talk to, they're like, we have no idea what we're doing. That literally is what he said to me. I have no idea what we're doing, right?
Scary.
It is, but this market has changed so much from the last time they purchased a home. So how do you put that packet together? How do you educate and inform them in a way that they can continue to make the best moves for their family in all? I mean, first-time home buyers are going through the same like information overload right now. Retirement mortgages. Are you knowing how to do one of the retirement packages that we have? Can you do a reverse for purchase, a cash out refinance with a reverse refinance? Do you need to know how this works? Our team does a lot of them. How do you strategize and get somebody into a more age appropriate home, given all the equity? If you are not knowledgeable in this field and using it as a strategy, we need to talk so that we can arm you with the information that you need to be able to bridge this gap, because they're a big part of our sellers and our buyers. Then Gen Z, per the NAR report, they make up 4% of the buyers. They were like, somebody wrote an article on this saying at the other end of the spectrum. I was thinking it was pretty good. Like they were downplaying the 4%. I'm thinking these are babies. My oldest is the oldest of the Gen Z and he's 25.
Wow. And
the fact that they make up 4% of the buyers, I mean, that's awesome.
Yeah.
I love that. So how are we tapping into this? How are we informing and educating and put together a path for them? How are we making it easy in a place where they're on information overload? In fact, I was reading another article. They were talking about more dumb phones. have been sold this year to date than in the last number of years, because this Gen Z is on information overload. They want to
Really?
get off all the socials and just get back to community.
Wow.
That's a big deal.
Yeah.
So how are you reaching this group of buyers? They're 4% today. They're not going to stay this low. We've got to be continuing to re-execute our messaging to actually meet them where they're at and give them that path. So down payment assistance, a phenomenal class. We could do a class very quickly on all the down payment assistance options. There are so many, including if you or have relatives that owned a home in one of the red line areas and get in the social equity program, the $15,000 to $25,000. I know that there's other programs either based on income or based on demographics that you can tap into. Do you know all of those options? And can you put together a 1-hour webinar, a first-time homebuyer class, a happy hour? I'm sure they'd love that, right? How do we do that? So we're doing that for a number of our real estate partners. We'd love to do that with you. So let us know. Colorado, SoCar actually has a savings account that you can put money into that grows tax-free if you use it to purchase a home. Do you know about this? Can you get this out to your network? So making sure to tap into and know all the programs. In fact, Fannie Mae just came out with a new program that if you're caring for a disabled child, you can buy a home for that child with as little as 5% down as a primary home and get primary home interest rates. That's brand new. It's a new twist on an old program. It used to be that you could buy a primary home for a parent, which I did for my mom. I bought her home as a primary home for me, but it was for my mom. I put that on the paperwork. But as a child, you had to do it as a second home, 10% down, second home interest rates. Now with this program, if they're disabled, but they're fully functioning, they want to live separately, you can buy it now as a primary home with as little 5% down with the primary home interest rates. That's a phenomenal product to get out to your database. This car savings account, the down payment assistance, put together a happy hour webinar on all the programs that are available, maybe the myths, the 10 myths of home buying, that you don't need 20% down, that you can have a 580 credit score, that you don't need to save up money, you can use down payment assistance. All of the things. How do we continue to communicate to this market that right now is 4% and growing? And here's the other stat that just came out of that NAR report, that all generations expect to live in their home for 15 years.
15 years.
15 years. The Gen Z expect to live in there for 19.
Wow.
That's a long time. So if you're expecting repeat clients, think again, right? So you need to be sharpening your saw when it comes to investment options. If they're not going to move, then how do I help them build their wealth through real estate, right? So are you having those conversations on a regular basis? I mean, Megan and I are here to serve, right?
Yeah.
We want to help you get more clients, and we want to help you get more clients in your pipeline. How are you having those conversations with limited inventory right now and still having strong demand? We have to make every single transaction, every single conversation, and every single opportunity, make it worth it. Having these in your tool belt makes sense. And we're doing a lot of second liens. Another thing that we picked up with the move is an in-house HELOC. So we're doing second loans, home equity lines of credit. Right now, we've got already 2 in our pipeline where we're helping our clients take out some of that equity, then turn around and purchase. So if you want to talk about, they are a little bit strict on the income. Sometimes I can get a little creative on income. We're going to have to get a little bit more straightforward with the HELOCs, but giving you the opportunity, we do investment properties, second homes, and primaries. So phenomenal opportunity. So I'm going to land the plane, and then we're going to stop sharing my screen, but I'm going to land the plane on the fact that a big reason for our move was community. So the Ruth team is the same Ruth team. It's the same people. It's the same turn times. It's the same service levels. The last week, we made a big move, though, to Movement Mortgage, which is an impact lender. That impact lending, if we assess credit the same, we have similar financing options, similar process, same team, same gathering documents, same underwriting. But if I told you 50% of our net profits go to charity, go to building schools, go to medical centers, go back into the communities, go to nonprofit support across the country. If we could partner and give $10,000 to your nonprofit, would that make a difference to the people that you serve and who you stand up and are in your community? Would that make a difference?
That's huge.
It would
That's
make a
really
difference.
impressive. I didn't know all that. That's really
Yes.
impressive.
That's the reason why we shifted. We shifted because it's our people, and you know who the Ruth team is. You know the Ruth team. We give away more than we receive, and we love to give good gifts. This is an alignment. So how are we partnered with a company powered by who's giving away 50% of their net profits to those kind of organizations? So it's huge. How do we partner together to do more of that? How do we make more of an impact on our community? Because you can refer a lender and they can do a loan. But is that loan going to continue to support the community? That's the difference, and that's impact lending.
13
right.
questions. You
Let's
got
roll
1 minute.
I know.
1 minute
Oh,
to
we
get
got
through all these questions.
More Skyline, average price point. Oh, we answered that
Look at
one.
that one.
Oh, it has Castle Rock, Castle Pines.
They're sitting at about 2 months worth of inventory right now in Castle Rock.
Okay. Tough times won't last long. Tough people do. That is so true. Thank you for the weekly updates. We love that. A whole lot of deadlines. Great info, Megan, always on the quick claim deeds.
Yes.
Good information.
Don't quit claim your own properties, please.
Buy down strategies make sense. Can you elaborate on the price and cost for each option? In fact, you know what? We'll send a buy down marketing piece along with our email later today, so you guys can have that. Yes, Stephanie, Gabe did a great presentation. He's amazing. Can you send the NAR link? I can do that.
I'm also doing another reverse mortgage class with Gabe on May 8th.
Yes.
From 9 to 11 in the morning. It's a Monday.
Okay.
And so hopefully we can get that out. I will start advertising that next week.
That's
and
fantastic.
It filled up fast. I've only got 40 spots, so sign up for it fast.
It will fill up fast. Want to hear more about the primary home interest rates with parents and disabled children and the HELOC rates? We've got so much information. You know what? I'll do a quick couple of videos. We'll start putting all of that information out. Super excited to keep sharing what we've got. Yes, excited to work with us in Movement. Love having you guys here with us each week. Such a blessing to do what we do, isn't it?
It is.
Guys, we are in the best industry that there is. We are the ones that can support our clients to have a lasting impact, to change the trajectory of their lives. We have the ability to do that. And yes, this quarter's been tough, not nearly as tough as the fourth quarter of last year, but it's still going through change and transition. And as it does, continue to lean on partners who you know have your back and want to serve. I know Megan and I, we stop what we're doing, we go research the answers, we answer emails all day long, don't we?
All day long. All day long. I start at 4 a.m. and I end at about 6 o'clock at night. So I am almost always available.
So reach out. In the meantime, we really do hope to see you at the closing table. We hope to support your clients as we continue to go out there and fight the good fight against all this lack of inventory. Reach out to Megan Allard, Nicole Ruth, and you guys have a fantastic weekend.
Thanks, guys. Bye-bye.
Bye-bye.